In this video, I'm going to talk generically about funds and describe the advantages they bring and why you should invest in them. So what are funds? Just so that we're all on the same page, some examples of funds are mutual funds, index funds, and exchange-traded funds. When investing in a fund, you are in fact investing in a group of stocks, bonds, and sometimes commodities such as gold. So one clear advantage of a fund is that you only need to make a single purchase to invest in hundreds of stocks. The alternative would be to make hundreds of purchases to invest in the same group of stocks. Not only would that be impractical, but it would also cost you significantly more in fees. So let's look at an example. The Vanguard FTSE 100 ETF, or VUKE for short. By purchasing this fund, you get access to the biggest 100 UK stocks for a very small ongoing charges fee of 0.09%. A second example is the Vanguard S&P 500 ETF, or VUSA for short. Purchasing this fund would give you access to around 500 stocks from the USA for an even cheaper fee of 0.07%. The fee here is likely lower because we're benefiting from the economies of scale of having 5 times as many stocks in this fund when compared to the UK one. So I've mentioned economies of scale. If we dig a bit deeper into that, we soon realise that when investing in a fund, you're in fact investing alongside thousands, if not hundreds of thousands, of other investors. Funds allow us to pool our money together, which gives us far more buying power than we would have on our own. This huge pool of money is what drives the management fees of certain types of funds down, as the fund provider can use the huge pool of money more efficiently, giving them good economies of scale, which they can pass on to us in the form of cheaper fees. As you can imagine, this pooling of money also helps in diversification. With a larger pot size, the fund can spread itself over more stocks, which in turn reduces the risk of investment. Not only that, but your 10k investment is a tiny fraction of the overall pot size, meaning you have a tiny fraction of the total risk. There are some risks which funds cannot fully mitigate, namely currency fluctuations, such as using British pounds to invest in a fund held in US dollars. There is always an inherent risk in investing across currencies. The question you should be asking yourself is what happens when one currency falls in value against the other. We'll save that topic for another video. Investors who are focused on day trading rather than long-term investment often poo-poo funds because you cannot choose what stocks a fund holds. However, I like to flip this on its head and say that this is actually an advantage of using funds. Without the ability to micromanage the stocks within the fund, you have no ability to fiddle with the weighting of stocks, which would be too tempting for many of us, and no doubt we'd screw it up. Sometimes less choice is better, and if we're investing for the long term, we want as few moving parts as possible. The big question: when should you invest in funds? If your strategy is to invest for the long term, which I strongly suggest it should be, funds offer a great low cost and simple way to invest in entire economies. This can be done through a single purchase, such as investing in the VUKE or VUSA examples from earlier. If you don't know where to start on your investment journey, I would strongly encourage you to spend your time researching funds, specifically index funds. Every fund has an associated prospectus, which describes the fund objectives, and usually they're only a few pages long and are well worth the read. I'll be releasing a series of videos soon which will cover the specifics of the main types of funds, such as ETFs, index funds, and mutual funds. So click subscribe and stay tuned for those. Thanks for watching.